Okay, so just a quick video clip on statement of financial position. Firstly, don't worry about where the X's are. It's just loosely showing you where they would be placed. But especially if you're an A1 student, it's really not a big deal as to where they're placed. First things first, statement of financial position is all about how much a business is worth. And the basic calculation, which you should be aware of, is it's just really your assets take away your liabilities is equal to your worth. And then your worth is the equivalent of capital, which is the amount of money invested by the owner or the amount of money the owner can take out. That's a basic level. So we start with that idea of statement of financial position as at, because it is how much a business is worth at a precise moment in time. So obviously that can change on a daily basis. So we're saying at this point, as at, it's worth this much, but it can change because of a variety of reasons, like more money in the bank, more assets purchased, whatever it might be. And so the key thing you need to be aware of is just the key terms that are included. So we start with what we call non-current assets. So any asset is an item that a business owns that has financial value. So when we look at non-current assets, we're looking at large value items. So assets that will last for longer than a year but have a significant financial value. So here we have like property, fixtures and fittings like furniture, equipment and vehicles, but it doesn't have to be those. You can have computers. It depends on just completely depends on the business as to how they want to classify those. With a normal statement of financial position, you would have depreciation, so how much the assets fall in value over time. And then we have net book value, sometimes called carrying amount, which is the deduction of depreciation to date from the cost. You're not going to have to do that in your first A1 assessment, so if you are concerned in that way, just add up the cost values. When we look at then, we have current assets. So current assets are short-term assets. They still have financial value, but they're going to last less than a year. So these are any items that will be turned into cash within the next financial year. So not usually accessible, but we would normally put them in reverse order of liquidity. So the least liquid, also the most difficult to turn into cash, is first. So in this instance, it's inventory. So inventory, clearly before we're going to turn it into cash, we're going to have to sell it and get paid for it. So obviously that's quite slow. Trade receivables, anyone that owes us money. So they're going to pay us money in the next financial year. That's an asset, but clearly they might take their time. So it's not that liquid because the most liquid is going to obviously be cash. So once we've got the money, we can actually spend it. And so current assets, all items that we can turn into cash, not necessarily just what we can sell, because there's three different types. Current liabilities, anything we owe money for that needs to be paid within the next financial year. So the most common one, trade payables. So these are suppliers that we owe money to, and so we'll be paying them. Obviously, usually have 30 days credit or whatever the agreement is. But anyway, trade payables is a normal one. You could have a bank overdraft. So bank overdraft is a negative bank balance. So if you've got a negative bank balance, it is on the credit side of the trial balance. If you've got a positive bank balance, it's on the debit side. So keep an eye out for that. But all our current liabilities are ones we need to pay back within a year. What we then look at is what we call net current assets. So you think net of. So it's our current assets less our current liabilities. So effectively, if our current assets are higher, that means we have enough liquid resources to pay our short-term debts. So clearly that's beneficial. That's what we need. If it was negative, that means our short-term debts are higher than our short-term assets that can be converted into cash, and that can be very problematic from a cash flow perspective. But it happens a lot. So our net current assets less current liabilities. We then, depending on the situation of the business, could have non-current liabilities. So non-current liabilities, well, clearly any debts need to be paid back over a year. So usually a loan, you can have a mortgage in there as well, but any long-term debts. The final line of the top half of the statement of financial position is what we call net assets. So net assets is basically how much we're worth. So the general calculation is our non-current assets plus our net current assets. Obviously, it could be negative, but either way, non-current assets plus net current assets less our non-current liabilities. That gives us our net asset valuation. Now, you could do that as well. You could just add up all the assets, so add up the non-current and the current, and take away the current and the non-current. You don't have to do it the exact way that I put it there, but either way, assets take away liabilities equals our net asset valuation, which is how much the business is worth. The bottom half of the statement of financial position with this particular layout is called capital, and this represents the owner's investment in the business. And so what we're looking at here is opening capital, so the amount of investment that the owner has put in the business over the years, add any profits we make. So profit is, well, We've already looked at the income statement, so it's the overall profit for the year from the income statement. So we would add that. Now, clearly, if we've made a loss, we would deduct it. We've then got drawings. Now, drawings is any money taken out by the owner. It doesn't have to be cash. It could be stock or anything they've taken out of the business that has financial value would reduce the amount of money that they can therefore take out in future. So we deduct the drawings. That gives us our closing capital. So that's the overall owner investment in the business. And then obviously that becomes opening capital next year. The closing capital figure has to balance to the net assets figure because they agree. You have the accounting equation as assets take away liabilities equals capital. The accounting equation we'll look at in future in A1, but that has to balance. So if you've got them both in agreement, there is a good chance you're spot on. And that's a good double check. If you haven't, you might have only made one mistake. So don't get too stressed. Just double check through all your figures. Okay, that's a statement of financial position.